Well, hello there, beautiful people of the internets. This is Brandon with Crypto Trades and Tech. I'm going to try to do a weekly recap. Just thinking about my time and the time and energy that I have to make videos. I was trying to do daily recaps by popular request, but I just don't have the time for that. So maybe we can start with some weekly recaps. And for this week, I wanted to address a topic. So I got into a discussion on Twitter about, past model cycling and ultimately, when it comes to Bitcoins, the past models, the past halvings, and what's happened with the price history, here's what I believe is playing out. I believe that not enough market participants understand the halving. And because of that, it changes the supply to demand ratio, and that creates a supply shock. Then that supply shock sends price into price discovery. So it eventually causes price to move into the prior all-time high and overtake that. Now, once price enters price discovery, I think the supply shock is somewhat behind us, as now when we enter price discovery, we really enter a new paradigm, and this is where the supply shock drives the price discovery event. And then once we're in price discovery, then that's where the market starts to normalize around the supply shock that not enough participants understood. Then you have basic human psychology. Once an asset enters price discovery, there is usually some media news, especially bigger assets like Bitcoin would be one that is well covered nowadays, right? That creates a certain human psychology, especially among retail traders, but amongst all participants. That includes retail, institutional, and nation states, whoever might be involved. And that drives certain market dynamics. So ultimately, and then I say, that's it, that's all, I trade accordingly. So ultimately, as long as certain fundamentals are not well understood by the market, like how Bitcoin's supply gets introduced into the market, then it's going to continue to drive this. At some point, this will be figured out and will be priced in. At some point, the models will break because enough participants in the market will understand the supply-demand changes and what's going to happen when the miner's reward gets cut in half. And every time as well, the miner reward becomes less and less of a driver because the miner's reward over time, as it continues to get cut in half, will drive less new coins into the market. Granted, the price should be significantly higher, so it will have a similar impact. But at some point, enough market participants will understand that. Now, before we go any further into the discussion, I do have to just make sure that everybody understands that I'm not a licensed financial advisor. And so if you just blankly take things that I say today and you go take trading action on them, you're probably just going to lose all your money and end up living in a van down by the river. Now, hopefully it's a happy little van, but, do your own research, please. Now, why was I so kind of dogmatic about this is what's going on, that's it, that's all, trade accordingly? And then we went into this discussion about, the halving caused you to buy? And I said, no. Technicals, right here is a chart of the technicals I was looking at, the breakout. That's when I started building my position, is on this breakout. I started building my position pretty heavy in both Bitcoin and Ethereum, and I was playing the two of them accordingly on this breakout, and then shortly thereafter I started building position in some alts. But what clued me into the fact that a breakout might be coming was the halving event. And I was one of the market participants that was aware that was going to change the supply-demand dynamics. Now, when you think about supply and demand as well, one of the things we have to keep in mind is that demand is not constant. Demand is constantly changing, but it's not a constant linear increase. For Bitcoin, the demand continues to increase for a number of reasons, mostly as more market participants come to understand the asset more. But it does go down from time to time too. So there are events that happen with Bitcoin, legitimate, and then most of them are fear, uncertainty, and doubt. But some of them are legitimate that will cause a decrease in demand of the asset. So while supply is pretty fixed and that gets adjusted every 210,000 blocks, demand does change. So therefore, price action is going to move around demand as well as supply. So the halving is one half of the equation, but not the whole equation. But as you can see highlighted here, obviously this is where I built my position because I knew the halving was behind us. The supply shock would start to take effect, and that was going to drive us into the prior all-time high. Now, here's what I mean by for me personally, I don't follow this halving price. I love the work Charts BTC does, and a bunch of others do really good work. And what I like about Charts BTC is he started lining up the halvings and the counts according to blocks and not according to date. So now we can see a block adjusted. Now this was back on June 1st, so it's been 20 days since then, so we're below this. But as you can see here, this is a block adjusted chart. So we're not tracking dates on this chart, he's tracking blocks. But the problem with trying to follow this is the demand side of the equation is very different for each cycle. There's macroeconomics that drive different demand. For example, in the first cycle, the demand was mostly driven by speculators who were starting to understand and learn a little bit about the asset. And so price did different things as speculators drove the price. In the second cycle, we had kind of harder monetary conditions where the dollar was a lot stronger and other assets, speculative assets, were more suppressed. And so Bitcoin had a slower ramp and then a stronger finish as at the same time that Bitcoin was really hitting its stride in the bull market, there was also a weakening of the dollar through softer monetary policy that then potentially might have driven this cycle to perform a lot stronger toward the end than it did toward the beginning. In our current cycle, we entered the market, entered the halving in the midst of a massive round of stimulus, uber easy monetary policy. In my opinion, this led to a stronger start in the market, as you can see here. And now that we've had that strong start, we're rolling over and then we're going to have to consolidate. So the market is going to look different for a number of reasons. Now, I don't think this is the top, and I will consult this data, but I'm not going to follow it. There's a big difference between taking this data and following it. Let me give you an example. I've got pulled up some tabs here that we can discuss if we have time today. But here's all the data I might consult. This might be one piece. I'll consult the stock to flow ratio and where we're at with Plan B stock to flow. I'll consult data like unspent outputs. In all these charts that we see here and look into Bitcoin, the R holder ratio is one that I've been watching closely. I'm watching active addresses. Back to the stock to flow model. The 200-week moving average heat map is something I might consider. Options expiry is something I might consider. Balance on exchanges is something I might consider. So all of this data, these are data inputs into what I might take a look at when going to do and analyze current price action. And it might color my opinion about current price action. But what I do is I trade current price action. So all of this is data that'll feed into my general analysis. Now, let's go look at the chart. All right, I found a feed that I cleaned up here. So, for example, I've talked a lot about past market cycles and the interaction of the 120-day SMA. So, when looking at past charts and past market cycles, what I noticed is there's a couple of moving averages that really give us a lot more data than others. And this is the Bitstamp. Now, personally, I went and did this evaluation on my own. So I'm looking here at the 2013 market cycle. And a couple of things I noticed was separation from these moving averages would kind of give us a good heat map. So separation from the 200 or the 120 or the 50. And the further we separated from those moving averages, the more likely we were to come back down to test them at a price point lower than the moving average. It means it would wick down below it. Now, I noticed here that you look at the 120-day SMA, you can see that in the first cycle, we held it as support, lost it, came back to it, wicked down to it. Right there, you can see the interaction right there, kind of build a bull flag, and then off we went. This cycle, obviously, again, was more driven by speculation. It was a lot more volatile than I expect the current one to be. So this is how I use past data. As I'm looking at how price in the past has interacted with certain levels, what sort of psychology drove what sort of events. Another key point to notice, in 2013, again, this was early adopters and speculators, right? And then now let's move forward in time to 2017. Now 2017 was broader retail participation. So this wasn't just early adopters. This was still early adopters, actually, but there was a lot more. What really drove this top was, if you remember, there was a media frenzy, and people who knew nothing about technology or cryptocurrency were buying through here, right? You've heard the stories of people who just heard about Bitcoin, thought it was going $1 million and mortgaged their house and so forth and so on. So a broad media frenzy and broad retail speculation is what drove this market. Now, we can learn clues from this market. First of all, for example, the harder monetary policy may have caused a slower start to the 2017 market and then a stronger ramp at the end. we can see in this market some things like once the bull market really got going, it never lost momentum, never lost certain key moving averages. It always stayed above from this point on. It stayed above except for a quick wick below the 120-day SMA. And certainly never got below the 200-day SMA. Now, the same basic supply-demand ratio, dynamic rather, is what drove that last market. Now, as you can see, I'm going to get rid of these bright arrows here. Back on my master kind of log chart, we see that we have the halving events. So I do consult, of course, the halving events because that is a change in the supply-demand ratio and that relationship. And ultimately, all markets are driven by supply and demand, right? So we can see that when we mark out the halvings, we mark out the time from the bottom to the top, we can see that there's definitely a metronome type event that happens right around the halving. So this is because not enough market participants are aware of the effect of the halving. And so when more market participants become aware of it, when the market at large becomes aware of it, this metronome around the halving will likely fade away. But that will take some time for that to happen. The other thing, again, is every market cycle is going to be different because there are much different participants involved. So this last market cycle, of course, we've seen adoption from companies adding Bitcoin to their balance sheet and now sovereign nations making Bitcoin legal tender. This changes the demand dynamic significantly. What's in common is that what really started the strong price action was the supply shock that was set off by the halving event. You can see it's nicely timed. It fits nicely. Right there's the halving event. We were going largely sideways, making some recovery, but we really broke out shortly after the halving event. Now, why do I not consult past models like per se and try to follow these halving trackers? Well, again, the demand side of the ratio, and the supply side is well understood now by those of us who study this, but the demand side is constantly changing. So when we study closely our current cycle, you'll see that demand, the supply shock combined with strong demand from easy monetary policy, speculative assets have been getting a very large bid from late 2020 through early 2021 because of the monetary conditions. There's a lot of US dollars, a lot of fiat currency, not just US dollars, but a lot of fiat currency around the world being flooded into the system. This is another reason why it's going to look like this bull market is over by a lot of metrics. So what's gonna cause people to really struggle soon by trying to follow these types of models is that we're going to see a breakdown that looks something like a bear market, a lot more like prior bear markets, but then it very well might recover. Why do I say that? Because there's a lot of fundamentals, both the stock to flow model, on-chain analytics, and especially on-chain analytics, and just the macro thesis around Bitcoin. The case for Bitcoin is as strong as ever. But obviously what happened was we had a much larger increase percentage-wise. So from the halving, let me just illustrate this for you. From the halving to the peak price, we went up 670% in 342 days. Okay, so that's how far we were up. Now let's go 342 days out, last cycle. 342 days out, and we were 361% up. So by the nature of just mathematics, we were up almost double on this point in the cycle. Therefore, my opinion is that the sell-off is going to last about twice as long and be nearly twice as deep and look something like that. That's just how markets work. So let's measure this out. From this point, this peak that I just drew, I'm going to have to remove this. From this peak to that bottom was 39 days and a 40% sell-off. All right, so let's double that. Let's say that's really 36 days roughly. All right, let's double that. Let's go 72 days. Okay, so I've measured it out. 72 days puts us late this next week, June 24th. That'll be roughly double the prior sell-off. And you can see here, coming into the very bottom of my channel that I've drawn. Now, I've anchored this channel on what I think is the midpoint of the price action here. And I think that we're going to have more or less a double wave where we take some time to recover. But this is the first peak of that first wave, really. That would put us at a price right at $30,000 coming in late this week. Now you see how I use that past model, and I did some analysis and some estimates. But what am I ultimately looking at? I have on my log chart here, I have a channel. Coming into the bottom of this channel would be a place to potentially buy. But now let's go look at my main Bitcoin chart. What am I actually trading? What would I actually be taking action on? I might consult that to go, okay, that lines up. That might seem like we might come into some price action there. But what I see here is these moving averages are curling downwards. We have our little death cross. What I'm waiting for is if I'm going to buy a falling knife, I'm going to wait until we come into a very significant level and try to play the bounce off of that level. And then if we break down off that level, I will sell coming back into that level, right? So I'm going to find a level. 32,000 might be a good one. 30,000, 28,000, 26,000. All these levels are good levels to attempt to buy. Because that as price action interacts with these levels, it's probably, when it breaks down, it'll probably come back into it to retest that level. Let me show you exactly what I'm talking about. Let's go to the 4 hour. All right. So if you were to have tried, like I did, to catch the falling knife here at 38,000, because I didn't know if maybe this was a breakout attempt, right? We might have been trying to break out here. I had a trend line I was watching. We got to the other side of that. I tried to buy the dip right here. It fell, it failed, and it came right back into that level. Now, I could have sold right coming back into that level. I had a really tight stop loss, so I ended up selling right below it. But if you're patient, 9 times out of 10, if you buy a good support level and it loses that, you can sell as you come back into it and curl over, right? And that's your validation that it's probably going back down. You can see it happening here again. We just lost another interesting level. This held the support for a little bit, 35,500 roughly, and we've just lost that level. We bounced strongly off of the next level I had down, 33,408. And now we're coming back in at 35.5 to test it as resistance. Odds are that holds as resistance and we continue a little bit lower. Why do I say that? Because we need to find new supply. We need to tap new supply. So all these levels down here are candidates for that last new supply to come in to reverse the direction entirely. But at the end of the day, this might be a great place to buy and hold long term. But at the end of the day, we have to set this up as a trade. Let me show you how that would look. And so if I take a long position here, say I'm looking at this as a scalp play. That's how you have to look at it initially. I might, I might try to buy coming in 30, 28, and 26. I might put buys in all those. And then I'll get out if I have to. If we continue our downtrend, as we come back into those levels, I'll get out. But you can see here, my initial entry would be to try to play a bounce up as high as 42,000. So, say I take an entry at, let's say my initial entry. This is why it's worth trying to catch a falling knife at some of these levels. Say we actually come into 30,000. Let's just do 30,000. 30,100 or so. So my stop loss, is going to be a hard stop loss, maybe below 28,000. But I'm going to try my best to just wait and buy coming back into it. These are spot purchases. So that's how I would play it personally. Now, before we ran into resistance up here at 41,000, now this has been ranging, so we can try to play that as high as 41,000. Safely, we could probably take a trade, a 2-to-1 trade. So buy at 30, stop loss at 28, target of 35. There's a trade idea for you. That's how you actually take real trading intel and you do something with it. Now, hopefully, we've actually caught the bottom of the knife and we bounce and we confirm, we maybe come in this as resistance, you sell a little bit, but then you consolidate under resistance and you break through and you just keep riding that trade. And then on the other side, you've added down here, you've played this bounce, you got out a little bit, but you don't add back that position until you break some other major technical areas to the upside and confirm that you're in an uptrend. So this would be a scalp playing the bounce after a strong sell-off, right? So we're trying to play a dead cat bounce. Most likely we're going to come back into these moving averages sooner rather than later to test them as resistance. That's when the safe long-term entries come into play. So for me, above 42,000, which should put us over the 200-day SMA, is where I'll actually put in long positions that are not scalps, that are meant to be ridden for a little while. My initial take profit will be the 120. I'll see how price interacts. If we curl off the 120 and confirm it as resistance, I'll take hopefully take a small win. If it looks like we're consolidating under it, there's a subtle difference between consolidating under it and curling over. You just have to have some experience with looking at that. We can talk about that in another video perhaps. But what I'll do is I'll try to push this trade, and hopefully we break through and then I can keep moving my stop up. So if my stop loss originally was, say, down here, this was my entry, right? So as soon as we come into that level, I'll move my stop to break even, and then I'll try to manually exit some if it looks like we're curling over for a small profit. If we're consolidating underneath the moving average and we're going to break out, I'll just keep my trade on as much as I can. And then once we break out, I'll move my stop loss under that level. Now, there's probably going to be other key technical levels that we're watching that will give us a hint. This moving average is just a general indicator of momentum to me. I don't use it to play actual levels. You can see the level I'd be playing, for example, that's close to the 200-day SMA, is actually the 42,119 January high. That's the actual level I'd be playing. I'm just noticing that happens to be close to both the 50 and the 200 right now. This up here is, according to Jordan from Conquer Trading Investing, this is the most important trend line in crypto. When we break that, that's when it's game on. You can see here, that nicely it looks like it might coincide pretty well with my 120-day SMA. And we'll see what happens with the 50 if we're curling back up here. But that's how I trade around the market. That's why I say I don't use past market cycles. I take them in as potential data that, okay, for a number of reasons, including those halving trackers, I don't think that the bull market is over, but I'm not going to assume that price is going to play out like that and trade according to that. I'm trading according to a mountain of other information. That's just one of many, many data points. And I think it's the best way to play all of this, is not to put your stock into one specific model, but to use it as a data point and to reference it and then to make informed decisions based on those multiple data points. So this is fundamentally, if you think about it, I for that sake, that model and other models, really the stock to flow model, and core on-chain analytics, like the R-HODL ratio. As you can see here, there's a nice analog to where we peaked out the R-HODL ratio in 2013, and then we had some resistance that we came into. This, to me, we haven't reached a oversold or overbought, territory yet on Bitcoin with as far as the R-HODL is concerned. And that's one of the key ones I'll be watching. But yeah, the stock to flow, if you look at where we're at, let me go over to 2020 here on Glassnode. Hopefully I don't get in trouble for sharing this. You can see we've been drawing down. People have been moving coins off of exchange. Now, I think this is more because people involved are more informed about how to self-custody, and then also the prevalence of decentralized exchanges, I think, is what's actually causing this bleed down on centralized exchanges. When you can self-custody your own coins and still be able to make trades, that's a pretty powerful reason to pull your coins off exchange. Plus, I don't think a lot of yield aggregators and lending platforms are included in this either. But nonetheless, the available float to be traded is reducing. And there are many, many metrics that show that coins continue to be taken out of short-term holders' hands and put into long-term holders' hands. That's another key metric to watch, is how much of the supply is in long-term holders' wallets versus short-term wallets. And that ratio has been flipping in this sell-off. It has been returning back to long-term holders. The long-term holders were selling as we were making those $50,000, $60,000 highs, and short-term holders were buying, and now the other way has reversed. So there's several metrics that tell us that we're likely headed for another uptrend, that we're just consolidating here after a major sell-off, and there's a couple of reasons for the sell-off, but largely the amount of liquidity involved in the market. But that's going to cause a longer consolidation period than many expect. It's going to cause many to expect the 4-year cycle is broken and so forth and so on. But none of that matters. As long as we trade accurately around current price action, as you can see here, without knowing anything about the 4-year cycle, all I can do is look at this chart. Let's just illustrate that. This is a very strong uptrend. It's a very volatile asset. We are now in a downtrend and we're heading down. The right thing to be doing here is to actually short. So you really should be shorting coming into these resistance levels on down, which is really the right play for an accurate short-term trade. However, if you color your analysis and say, okay, but this asset, depending on the time frame you're looking at, this asset is still very bullish, the better play than shorting might be to scalp the bounces, and hopefully one of your scalps, you actually catch the breakout. That has nothing to do with the 4-year cycle. That has just everything to do with trading and knowing how to trade around these markets. Let me zoom in a lot here and just show you something, another little trick that you can add accuracy potentially to your trading. So you see this little downtrend I've drawn in here? So I'm going to make it as accurate as I can on the 4 hour. So I'm just going to go to these outer touches up here. You can see that you could probably clone this or adjust this. But when you look at these big sell-off events, the best way to find the level that very well might bounce is to wait for a break of this level, of this downtrend, and then for it to come back into it, and then resume off. For example, you can see here that we bounced off of this support level. Likely, or initially, we're going to find this as resistance because of how long of a time that held as support, but we lost it. So most likely, we're going to come back down. Now, this bounces around, and you get a breakout here, a retest, and a resumption down here. There's a really good chance that actually this is the bottom. Now, you may continue range bound, but hopefully, you can catch yourself a nice little move back to the upside. That's how you can try to catch market reversals, right? Is to follow these sell-offs, wait for it to bounce off of a support level and get on the other side of this, and then give you some resumption signals. Now, be careful of buying right into resistance. So you could get a resumption signal right here and just buying right into resistance again. You can't really take that at that point, depending on how close you are, what your risk reward is once you measure where you would have to place a stop loss. This would be a terrible trade because you'd have, you're buying right into resistance. The better trade is to wait for the next breakout, retest, and resumption off of there, or even try to buy the retest. This is a Heath, for trade talk type thing to do. So if you break out, buy the retest, set a super tight stop. That's what I've been doing more of, layering in some of those trades. I'll do a little bit of both. I try to, sometimes I'll take the breakout on crypto. You take the breakout, right? So right as it breaks, take the breakout. Then you can add some more on the retest and add some more on the resumption. That's 3 small entries that you can set pretty tight stop losses for, and hopefully improve your accuracy of trading there as well. I'm going through all this just to illustrate why I say I don't follow the models, because I don't. I follow price action. I'm trading as accurately as I can on current price action. I've held Bitcoin from before $10,000. I actually have some Bitcoin that I bought I mined way back in 2013, maybe 2014. So I've held some Bitcoin since 2014. So, I've been a long-term holder for a long time. And so that's a different game than trying to trade and be accurate with trading. But this is the exact same strategy that I used to find the top on and sell the top, or relatively close to the top on Cardano and Ethereum. So I had some fib levels that I mapped out here on Cardano, and this actually happened to be, I think, the 1618 level. That's where it came into right there, the 1618 level. And I think I did sell just a tiny amount, maybe 5 or 10% coming into that level. But when we broke this parabolic trend line, this uptrend, this breakout trend line, so we broke out of this. We were in price discovery, I believe. Yeah, that was price discovery there. So this was a price discovery move. Price discovery moves are super great. I took this launch angle. And as we lost that launch angle, we bounced back up into it. That's where I sold, right here at 230. I sold right there. That was my sell, 80% of my Cardano after having built a position, a tradable position. Now, I have a long-term position. I have coins I won't ever sell, but my tradable position was built way back here below 10 cents. So that's how I held that trade all the way to 10 cents to this last final breakout. Ethereum, my trading position. I built this trading position in the 200s. I don't know exactly. You can go back, find my posts on a bunch of different places. But yeah, I was building an Ethereum position in the 200s, mostly back here, June, July. I don't think I bought much over 300 fresh. And I rode that all the way through this peak over here. Same exact thing. This came into the 618 level, or maybe even the 4. I can't even remember if I had to redo the fib levels for you. But it came into a fib level. These fib extension levels work great for this. So what I had was a beautiful concurrence of a fib level resistance, and that fib level came in right here. We tried to break out literally off the charts. This was the very top of my very top fib level. We took that. I sold some coins as we broke out literally off my charts. But then I waited for most of it. I sold most of it when we broke this downtrend, came back up into it as resistance, and I sold, and I got out right up to $4,000 of Ethereum. The same works on the downside, right? When you have a big sell-off, the same general principles are going to help us maybe not catch the exact bottom, but help us to position ourselves back into Bitcoin for the bounce, at least initially. That's what we're going to want to play. We want to play the bounce. If we're all long, we have a long bias on this asset for a lot of good reasons, a lot of reasons we talked about, all these different metrics that we can, from the halving tracker to stock to flow to all kinds of different on-chain analytics, moving average heat maps, even looking at options expiry. So we can do the same thing on the downside, right? So the downside, this is the trend line that matters up here. Now I have mine drawn slightly differently than what Jordan has, and this touch to this touch might be slightly more accurate. I will agree with that. I was trying to look at some other potential levels. So this is fine to watch. I have this one here because I feel like it's a safer, longer, and I have it drawn with, because this price action right here is my prime price action. So that's my prime price action. It's been a lot of really good, solid touches. And you can see it's even touching right now. It came back up into that level too. Right there. Right? So this has been a lot of, so I've cloned that trend line. That's a trend line I'm going to be using for my most important trend line in crypto. And I agree with Jordan. This is the most important trend line in crypto. It's going to so closely line up to my key 120-day moving average when it's all said and done. Those two together are going to give me really solid conviction that we're resuming. But that trend line right there, and then these sharper sell-off trend lines, and we hit this resistance and have a sharp sell-off. Whenever we bounce solidly off of a support and we break these very strong trend lines, that's a worthwhile time to try to play a scalp to the upside. But you have to be ready to take profits when it rolls over. So we'll talk about that maybe in another future live stream. But I did again want to discuss why I say I don't follow the halving tracker specifically or past cycles. I use them as one of many data points to help color, and to figure out where we might be heading. But I take trades based on my trading system that has nothing to do with the price action of prior models. Well, I hope this helps. Have a good one, everybody. And remember, this is not financial advice. If you made it this far in the video, I really appreciate your support. Please like and subscribe. Consider sharing this video and this weekly recap. Take care, everybody.